Have you ever opened your retirement account, looked at the balance, and quietly wondered, am I actually on the right track? Not because you're irresponsible, not because you've ignored your finances, but because deep down, you know one uncomfortable truth. Saving money and building wealth are not the same thing. Millions of hardworking Americans contribute to their retirement accounts every month. They never miss a paycheck contribution. They follow the advice they've heard for years. Yet many of them arrive in their 60s asking the exact same question: why doesn't this feel like enough? The surprising part is that the problem usually isn't income, it isn't intelligence, and it isn't bad luck. It's that most people spend decades following a strategy designed to make them feel comfortable instead of making them financially free. I'm going to show you a different way of thinking, not a secret investment, not a risky trading strategy, not some internet shortcut promising overnight riches. Just a simple approach that has quietly helped ordinary investors build extraordinary retirement portfolios. Ironically, it's also the strategy many people don't discover until they've already lost years, sometimes decades, of potential growth. The good news? If you're still earning an income today, you still have time to benefit from it. Let's begin with one of the biggest misconceptions in personal finance. People think investing is about predicting the future. It isn't. Successful investing is about giving yourself enough time for the future to work in your favor. That's a huge difference. Think about planting an oak tree. Nobody expects it to become enormous after 6 months. But leave it alone for 30 years, and it becomes something completely different. Your retirement portfolio works the same way. Time isn't just helpful. Time is the most valuable asset you'll ever own as an investor. Unfortunately, most people don't treat it that way. Instead, they spend years worrying about short-term market headlines. Every correction feels like a disaster. Every recession feels like the end. Every red day convinces them they should wait until things calm down. But here's something history has shown again and again. Markets recover, businesses grow, innovation continues, and patient investors are usually rewarded. The people who build serious retirement wealth aren't necessarily the smartest people in the room. They're often the ones who simply refuse to interrupt the process. Imagine two neighbors. One checks his investment account every single day. He reacts to every headline. He changes funds whenever the market gets scary. The other neighbor barely looks at his account. He invests consistently every month. He ignores the noise. 25 years later, which one do you think has the larger portfolio? For most people, the answer isn't obvious. But research has repeatedly shown that constant emotional decision-making often produces worse results than patient consistency. That's because investing isn't just a numbers game, it's a behavior game, and behavior compounds just as powerfully as money does. The biggest advantage wealthy investors have isn't secret information, it's emotional control. They understand something that beginners rarely appreciate. Volatility isn't the enemy, panic is. A temporary market decline feels painful. But over a working career that lasts 30 or 40 years, those declines often become the very moments that create future wealth. Because every paycheck invested during lower prices buys more ownership than it did before. It's like your favorite store putting everything on sale. Most shoppers celebrate. Investors panic. That difference in mindset changes everything. Now here's where the story starts to change. Most people believe the key to building wealth is finding the perfect investment, the perfect stock, the perfect ETF, the perfect time to buy. But the investors who retire with real financial freedom usually didn't spend decades chasing perfection. They chased consistency. That's a much bigger advantage than most people realize. Imagine filling a bucket with a single cup of water every day. The first week, it barely looks different. The first month, progress feels slow. Even after a year, it might not seem life-changing. but keep showing up for 20 or 30 years, and eventually that bucket becomes a reservoir. That's exactly how long-term investing works. Small, regular contributions eventually become something much larger because every dollar you invested years ago starts earning money on top of the money it already earned. That's the power of compounding. And here's the surprising part. Compounding isn't just about money, it's about time. The earlier your investments begin working, the less work you have to do later. That's why experienced investors often focus less on chasing huge returns and more on simply staying invested. One habit separates long-term winners from almost everyone else. They automate everything. Every paycheck, money goes into their retirement account before they even think about spending it. No guessing. No timing the market, no emotional decisions. Just steady investing month after month, year after year. It may sound boring. That's exactly why it works. The financial world loves exciting stories. The next hot stock, the newest trend, the investment everyone is suddenly talking about. But excitement rarely builds lasting wealth. Discipline does. There's another mistake people make that quietly costs them thousands of dollars over time. They confuse diversification with complexity. Owning dozens of random investments doesn't automatically make you safer. In many cases, it simply makes your portfolio harder to understand. Many successful long-term investors prefer broad, low-cost index funds because they own hundreds or even thousands of companies in a single investment. Instead of trying to predict which company will become tomorrow's winner, they invest in the growth of the overall economy. Some years are amazing, some years are disappointing. But history has shown that patient ownership of productive businesses has rewarded investors over long periods. This approach doesn't guarantee profits every year. Nothing can. But it removes one of the biggest enemies of investing: the belief that you have to constantly outsmart the market. In reality, many people would be better off spending less time watching financial news and more time increasing their savings rate. Because while returns matter, the amount you consistently invest matters too, especially during your highest earning years. Every raise, every bonus, every debt you pay off, those moments create opportunities to invest more instead of simply spending more. That's how ordinary incomes can eventually produce extraordinary retirement portfolios. Not overnight, not through luck, but through thousands of small decisions repeated over decades. And that's exactly how wealth is built. By this point, you might be thinking, okay, I understand how to grow my money. But what happens when it's finally time to use it? That's where many retirement plans begin to fall apart. Because building wealth and living off your wealth are two completely different skills. Think of it like climbing a mountain. Getting to the top requires strength, patience, and endurance. Coming back down safely requires a completely different strategy. Retirement works the same way. For decades, your mission is simple: save consistently, invest wisely, and let compounding do its job. But as retirement gets closer, your priorities begin to change. Growth is still important. However, protecting what you've built becomes just as important. One mistake many people make is waiting until the last minute to think about retirement income. 6 months before retirement isn't the time to ask, how will I pay myself every month? That conversation should begin years in advance. A smart retirement plan doesn't just focus on how much money you've saved, it focuses on how that money will support your lifestyle for the next 25 or 30 years. There's another piece of the puzzle that often gets overlooked: taxes. Most people pay attention to investment returns. Far fewer pay attention to how much of those returns they'll actually keep. That's why the type of retirement account you choose can make a huge difference over time. Some accounts give you a tax break today, but require taxes when you withdraw money later. Others ask you to pay taxes now, allowing qualified withdrawals to be tax-free in retirement. Neither option is automatically better for everyone. The right choice depends on your income, your future expectations, and your overall retirement strategy. The important lesson is this: don't think only about growing your portfolio. Think about keeping more of it. Even a small reduction in lifetime taxes can leave you with significantly more money to spend during retirement. Another powerful habit is creating flexibility. Instead of relying on just one source of retirement income, many financially successful retirees build multiple streams. That might include retirement accounts, personal savings, investment income, pensions if available, and eventually Social Security. Having multiple income sources gives you options, and options create confidence. Imagine driving across the country with only one gas station on your route. You'd probably feel nervous every mile. Now imagine hundreds of stations along the way. The journey feels much less stressful. Retirement works the same way. The more flexible your income plan, the more prepared you'll be for unexpected events. Because life rarely follows a perfect script. Markets change, inflation changes, healthcare costs change, your spending habits may even change. A retirement strategy should be strong enough to adapt when life does. That's why the most successful retirees don't simply hope everything works out. They prepare for different possibilities before they happen. And perhaps that's the biggest lesson of all. Financial confidence doesn't come from predicting the future. It comes from being prepared for it.
Here's something that rarely gets talked about. The biggest threat to your retirement isn't always inflation. It isn't taxes. It isn't even a market crash. Very often, it's your own emotions. History has shown that markets move in cycles. There are years when everything seems to rise effortlessly, and there are years when headlines predict financial disaster almost every day. During those difficult periods, many investors make the same costly mistake. They stop trusting the plan that was designed to carry them through moments exactly like those. Fear convinces them that this time is different, so they sell, they wait. They promise themselves they'll invest again when things feel safe, but safety usually arrives after prices have already recovered. Without realizing it, they lock in losses and miss the rebound that follows. This pattern has repeated itself across generations. The investors who come out ahead aren't the ones who never experience fear. They're the ones who refuse to let fear make their decisions. One of the most valuable investments you can make isn't in a stock or an index fund. It's in your own financial education. The more you understand how markets have behaved over decades, not days, the easier it becomes to stay calm when everyone else is panicking. Knowledge creates confidence, and confidence creates consistency. As retirement gets closer, your strategy naturally evolves. Instead of asking, "How fast can my money grow?" you begin asking, "How reliably can my money support the life I want?" That shift is important. Your portfolio is no longer just a number on a screen. It's the income that helps pay for family vacations, healthcare, hobbies, everyday expenses, and the freedom to spend your time the way you choose. That's why planning shouldn't start the year you retire. It should begin years earlier. Review your investments regularly. Understand your expected expenses. Know where your income will come from. And make thoughtful adjustments instead of emotional reactions. When you step back and look at the entire journey, the formula is surprisingly simple. Save consistently. Invest in diversified, low-cost assets. Give compounding enough time to work. Avoid emotional decisions. Pay attention to taxes. Adjust your strategy as retirement approaches. Repeat those habits year after year. There isn't a hidden shortcut. There isn't a magic investment that guarantees wealth. More often than not, financial success comes from doing ordinary things extraordinarily well for a very long time. And that's actually good news, because it means you don't need to predict the next market winner. You don't need perfect timing. You don't need to be a Wall Street expert. You simply need a clear plan and the patience to stick with it. Whether you're in your 20s just opening your first retirement account, in your 40s catching up on long-term goals, or in your 50s preparing for the next chapter of life. The best time to improve your financial future is the moment you decide to take action. Every contribution matters. Every year matters. And every smart decision you make today gives your future self one more reason to be grateful. Your retirement isn't built in a single year. It's built through thousands of small choices made over decades. Start today, stay consistent, and let time become your greatest financial partner. If you found this video helpful, don't forget to like, subscribe, and share it with someone who's planning for retirement. Thanks for watching, and I'll see you in the next video.